We have C.S. KRISHNAN as a speaker for today's CPE meeting on global taxation of individuals, residency, foreign income tax, cross-border taxations. May I call upon Chairman Pramod Hegde to escort the speaker. And please hand over the topic. I will request the chairman to give a welcome address.
Good evening, my dear members. Dignitaries on the dais, S. KRISHNAN sir, our treasurer C. Tupar, past chairmen below the dais, our newly elected committee members, Arvind Rainde, Ms. Chilch, and our current committee member, C. Chandraprakash ji. Welcome you all to this CP seminar. It gives me an immense pleasure that this being my last CP study circle which I am probably hosting, and the new committee will be taking forward. Of course, I do have one seminar before I close off my period, which is going to happen on 14th on direct taxes. So I thought, and also I'm very heartily to see everyone that the numbers are more. Is it because of the CPE last due date, or is it because of the subject relevance is what I was just thinking. So we were just discussing it downstairs as well. When we planned to do this topic, I thought international taxation is oftenly not touched, and it is very evident that, it's very important that we keep up with it, considering the global landscape as well, and also on a personal interest. I know most of us do not practice taxation. We have subject matters of expertise, but at least one of our relatives are abroad, and we always get this question that how do I tax? I'm getting an income here, and what are the DTTA benefits? I have multiple sources of income. At least to guide them and to keep ourselves saying that yes, I am a chartered accountant. The next question we get is, I thought you were a chartered accountant. If you are not able to answer, then you are not practicing in taxation. So we thought that let's discuss about this topic, keeping the jokes apart. And firstly on, we thought about the tax residency rules, and considering the foreign taxation of income, where what gets taxed, where, how, and how this double taxation can be avoided, and also the DTTA benefits which we often see, and what are the withholding tax compliances, how to reduce our tax burden in various countries. So, and also if you see now, the tax authorities are having much more information than us, so probably we might skip out certain important aspects. Probably they have things with them to catch hold of it. So I thought it was a very apt statement at this point of time. So without taking much of your time, I would like to thank each one of you for coming here today, and who've kept me supporting for the entire period. So I would request you all to keep up this pace so that you give the same amount of response to the new committee which is going to come when I take up the meeting. Thank you everyone, welcome.
Thank you, Chairman. I have a privilege of introducing today's speaker, S. KRISHNAN. KRISHNAN is an international tax professional with significant on-ground practical experience on globalization of company operations. He has managed the entire gamut of planning, compliance, tax audits, and litigations in international tax, income tax, and transaction tax, due diligence and contract structuring, as well as risk mitigation. He was earlier Vice President and Group Head of International Taxation at Infosys Limited. Over a period of 15 years at Infosys, he set up centralized international tax departments in Bangalore to manage tax compliances in over 30 countries across North America, Europe, Asia Pacific, Africa, and Russia. KRISHNAN sir has published an elaborate discussion paper on drafting foreign tax credit rules in India. He has written articles on onerous reporting requirements in US on its citizens and green card holders residing outside US and a taxation of alternative investment funds in India. He has authored a book on investing in Indian and foreign startup companies, providing an overview of the income tax consequences and forex requirements in India. He is a founder member of RAF, an independent and exclusive forum for tax policy research, analysis and support conducting research and analysis on important tax matters, including those relevant to India. Krishnan sir has personally managed income tax audit across USA, UK, Belgium, Canada, Germany, France, Netherlands, Japan, Singapore, Australia, etc. very efficiently. He presently advises companies on international tax structuring and performing the role of virtual international tax manager, providing tax health checkups and compliance oversight of international tax, employee mobility and transaction taxes. He advises alternative investment funds in India, US citizens and green card holders on tax compliances, reporting obligations and estate planning. Here we present you S. KRISHNAN. Thank you.
A very warm evening to all of you. I know it's tough to come to this kind of a discussion. I'm deliberately calling it a discussion after a hard day's work with all the traffic problems that we have. In fact, I left January at 5 p.m. and I reached here at 6:50. That is the kind of traffic that we have. And today, I want to have a discussion with all of you on this global taxation of individuals. When I want to talk about a discussion, it's going to be different from all the other kind of seminars or whatever you call. You have study circle meetings and things like that. And in this particular discussion, I am going to ask you questions, you will answer. This is the only way I ensure that all of you are awake. Okay. Maybe many of you will go away because you want CPE credit when I ask questions. In any case, let us know what you people know, because Bangalore is supposed to be the Silicon Valley of India and things like that. And there are a large number of international tax expert control. In fact, I recall when I joined Infosys in 1997, within 1 or 2 days of joining the company, I got a whole lot of emails. I then realized that every chartered accountant, every engineer in Infosys is actually an international tax expert. He will come back and say, I have spent less than 182 days in US, largely it was the US at that point in time. So why should I pay taxes there and pour out of questions? Everybody was an expert in double taxation, avoidance agreements and things like that. I had not even touched a double tax avoidance agreement till then because there was no need. So to that extent, let us see how many experts are there. How many of you are familiar with double tax avoidance agreements? I just want to know from a show of hands. So we have a quite large number of experts here. In which case we can close this session earlier. Okay. So let us start initially. See, the first issue before we talk about global taxation is, it is important for us to understand what are the tax laws in this country, what are the regulations in this country, and that will only give us the context of what a global taxation is. So many of you are aware of it, so let me just brush through these particular concepts. So we have these 3 fundamental regulations in India, which is section 4, 5 and 6, which talks about taxation in India. The first question that I want to ask all of you, which I do in many of the seminars on international taxation, is just about a couple of days earlier we had the budget which was announced by the finance minister. So the first question I want to ask all of you chartered accountants is, why do we pay taxes in India? That is the first question I want to ask all of you. Why do we pay taxes in India? Sorry?
They earn income, we pay tax. Source of income is in India?
Source of income is in India. We earn income in India, we pay taxes. Anything else? Sorry?
Development of country.
Development of country, okay.
Constitution provides.
Constitution provides us to pay taxes, we pay taxes. Anything else? All of these answers are common sense answers. This is not a chartered accountant answer. I am looking for a chartered accountant answer. Why do we pay taxes in this country? A simple question.
We are asked to pay it by the income tax act.
Definitely no option.
Charging
Welfare schemes.
Sorry?
So welfare schemes.
Okay. So I am disappointed, but anyway we will discover in the next 5 minutes why we all have to pay taxes. But one good thing about this country so far is that unlike the United States, there's a criminal liability in the United States if you don't pay taxes. Here also you have, but it has not been enforced. So to that extent, the fear of non-payment of taxes outside India is much higher than in India. But that's a different matter. So we have section 4 of the Income Tax Act which talks about the charge of income tax. It basically says that total income earned by a person every year, tax has to be paid. This is a fundamental rule why we have to pay taxes. And incidentally, if you see in this, if you see here, it also says by virtue of any provision of this act, income tax is to be charged in respect of the income of a period other than the previous year. We are all used to paying taxes for the previous year. Previous year is literally a financial year, so we pay taxes only in a financial year, and they just concluded a couple of months after that. So, but this provision also says that we can, if we are required to pay taxes for a period other than the previous year, that is also something that we may have to pay. So this will be in those cases where there is going to be a retrospective taxation. And then you have two mechanisms of paying these taxes. One is by the TDS and one is by the advance tax. So one of the very interesting statistics that we have been monitoring, and I have been writing about it along with Mr. Mohandas 5 years. Over the last 5 years, the amount of taxes which is paid by individuals in this country is higher than the corporate income tax paid over the last 5 years. Okay, so that is largely because you have a TDS provision, withholding tax as it is called outside India. Even before you get your taxes, the taxes is collected and supposedly paid to the government. So what you get is net of that. Okay, so that is primarily the reason why you have a very high collection of individual income taxes. And of course, another reason why you have higher income taxes, because earlier you had the dividend distribution tax being paid by the corporates, so that used to increase. Now that the corporate don't have to pay a dividend distribution tax, it is being taxed in the hands of the individual, so you have a higher income tax. But nevertheless, this is a very interesting statistics to see the contribution of individuals in this country is significantly higher than the contribution of corporates in terms of income tax. So this is section 4, which is the fundamental regulation. Next is, in continuation, you have income tax shall be charged in respect of the total income of the previous of every person. And then section 5 talks about the scope of taxation. So in the terms of section 5, it says what is to be taxed. Okay, this is very, very important. What is to be taxed in India is, if you are a resident, you have to pay taxes on your global income, which is what is said, received or deemed to be received in India, and then accrues or arises or deemed to accrue or arise in India. And the third one is very important, accrues or arises to him outside India. So all the income that you have earned anywhere in the globe is supposedly to be taxed in India. That is a fundamental rule so far as taxation is concerned. Now, in the case of a person not ordinarily resident in India, you have three categories. You have a resident, not ordinarily resident, and a non-resident. So if you are in this middle category, you have to pay taxes even on income earned outside India, it is controlled from India. So that is the only difference that you have. And then if you have in the case of a non-resident, you only pay taxes on income which is earned in India or deemed to accrue or earned in India. To that extent, whatever taxes, whatever income earned outside India is not supposedly taxable in India. So these are the fundamental rules of taxation of income. Now, there is this scope of total income. What does it mean? Now, if you have this non-resident, and then you have this definitions of who is a resident, non-resident. So this is where the problem that I find. If you look at section 230, which defines various things, in that resident is being defined. A person who is not a resident, and for the purpose of section 93, a person who is not ordinary resident. This is the definition for a non-resident. If you look at section 242, it talks about resident means a person within the meaning of section 6. If you look at this particular section, I am only reminded of this riddle. Earlier I used to say, where does Jack live? He lives next to, where does Jack live means he lives next to Jill's house. Where does Jill live? He lives next to Jack's house. Where do Jack and Jill live? They live next to each other. Nobody knows where they live. So today, if you look at these two sections, absolutely there is no need for this section because they are referring to section 6. In which case, why do we need? I hope with the new Income Tax Act, this kind of things are going to be rectified. It is only in the case of person not ordinarily resident in India, they have directly gone to section 6 to that extent. Now, this is the definition of income. This is again a very mysterious thing to me because we all have learned in income tax that in India, there are 5 sources of income. Can you all tell me what those 5 sources are?
Property.
House property. Sorry? Okay. Income from business or profession. Capital gains. Other sources. Okay. Do you find any of them here? None of them is literally captured here to that extent. So again, there is a disconnect between the sources of income you have and the income what it includes to that extent. But this is what the definition to that extent is. But literally what you people said is correct. Those 5 sources of income which comes in your income tax is what is to be taxed in India to that extent, and there is a computation methodology. Now, this is the answer to the question that I asked. Why do you pay taxes in India? You pay taxes in India because you are a tax resident in India. This is the chartered accountant answer that I was looking for. Everybody knows that you are required to pay taxes. What amount of taxes we pay, that's also under debate. But this is precisely the reason why we pay taxes. Either we are a resident in India, we are a non-resident in India, and not ordinary resident. That's a hybrid between these two. So all of you are familiar with this regulation, but I'll quickly go through it. An individual is said to be resident in India if he stays for 182 days or more. This is the first primary condition. The second condition, if you do not stay for less than 182 days, you do not automatically become a non-resident. There is one more clause which says that if you stay for more than 60 days with some combined conditions, you become a resident. Now, in the case of a non-resident, a person who is not a resident is what a non-resident is. This definition, of course, has undergone a little more change because of people who live in a country where there is no taxation, so that's a different regulation. I don't want to cover that. Broadly, you are a resident in India. If you stay in India, all of us, I presume, stay for more than 182 days. We don't even take that into account because we are all residents to that extent. Unless many of those software engineers or IT persons are there for now, they frequently travel outside India. So maybe they may be a tax resident, non-resident to that extent. So that is where you will have challenges. You will also have challenges in those years where you go out of India or you come to India. But this is predominantly the definition of what determining tax residency is. Now you have 2 more clauses here to that extent. So you have in the explanation, which is very interesting again here, being a citizen of India. This is the first time they are talking about citizen. So the first fundamental rule that we have to assume is we are not paying taxes in India because we are citizens of India. Let us be very clear. What is the example of a citizen of India who doesn't pay taxes in India? One, okay, you are a citizen of India, you are a resident of India. The other person who is a citizen of India who does not pay taxes is a person who goes outside India to that extent. So you will have citizens who live all over the world and they don't have to pay taxes in India, they don't earn income being a non-resident. So this is the two categorizations you have. But this is the first time you are hearing this concept of being a citizen. You are not so far paying taxes because you are a citizen in India. You pay taxes because you are a tax resident based on the substantial presence test. These two clauses that you have talking about 182 days and 60 days and 3 years and all those years, they are all substantial presence. So you are substantially present in India, and that is the reason why you are a tax resident. And those people who don't spend so much amount of time in India, they are non-residents to that extent. You will have some differences in some years where you go outside India and come inside, but we will rest there. So being a citizen of India who leaves India in any previous year for the purposes of employment, if this is the case, the condition changes. Outside India, the provisions of subclause C, this is very important, shall apply in relation to that year as if for the work 60 days occurring therein, the work 182 days has been substituted. So, if you are in a category, particularly if you are an IT person who goes outside India, in the first year that you go, you will have this particular substitution. So, to that extent, 60 days becomes 182 days. If you are there in India for less than 182 days, you become a non-resident in such circumstances. And the other clause is being a citizen of India or a person of Indian origin. So, you have this concept also, person of Indian origin, particularly for people who have become citizens outside India. You have a BIO card, you have a OCA. So those kind of people it will apply. This is for people who come to India. So within the meaning come, who being outside India comes on a visit to India in any previous year, the provision of clause C shall apply in relation to that year as if for the work 60 days occurring therein, the work 182 days has been substituted. So these are the two substitutions that you have so far as clause C is concerned. And then you have again, a person is said to be not ordinarily resident. You have again a substantial presence. You have 9 out of 10 years and 7 years categorization. Now let us look at this particular examples. A few examples we will see. So in the case an individual who leaves India for the first time on September 30th. So what is he going to be? He must be a resident, not ordinary resident. A person who leaves India for the first time on September 30th. What will he be during that year?
For employment or without employment?
It doesn't matter. He leaves for the first time on September 30th.
He will not be resident.
When he is
He will
coming
not be a
back,
tax resident.
He leaves for the first time. This is a simple question.
He won't be the tax resident.
Huh?
He will not be tax. He will
No. What is his status? Resident, non-resident, not ordinarily resident.
not ordinary.
Not ordinarily resident.
Not ordinary.
Anybody else? Non-resident.
resident.
I'm very surprised with this answer. That's why I said I want to ask questions. You people have passed your exams long back ago, so you have forgotten the fundamentals. What does this say? If you are in India for 182 days, it doesn't matter. You are a resident. September 30th, you cross 182 days. You are a resident. There can't be any doubts. Okay? So this question is a simple question. Answer is very simple. It itself says, you will always be a resident during that year. Let us look at the second. So essentially what it says is, up to September 29th, you will be a tax resident because you will cross 182 days by then. Okay? So let us assume somebody who lives before September 28th. What will happen then? A leaves India for the first time on September 28th. What will be his status? Sorry?
Resident but not
He will be resident. Okay.
not ordinary.
Not ordinarily resident. Anything else? Only a non-resident is that. How many of you think he is a non-resident?
If he is not living for employment, he is a resident.
Huh? He is not leaving for employment,
He is resident
he is resident.
because he crossed 60 days.
Okay. If he is not leaving for employment, he is a resident. He is leaving for employment?
Condition 60 days, 182 days.
Huh? He is leaving for employment. So we have two scenarios. Okay, we will take both the scenarios. He is leaving for the first time outside India for the purpose of employment. Is he a resident or a non-resident? He is a non-resident. Okay. How many of you think he is a non-resident? Let me come to that. It's easier for me. Raise your hands who all think that he is a non-resident. Okay, so few of you think he is a non-resident because he has left before September 29. How many of you think he is a resident? Some of you think. So the number of people who think he is a resident is lesser than the number of people who think, and the number of people who don't think is very high. They don't raise their hands. That is very, very sad. Okay? Let us look at these regulations very clearly. It says an individual is said to be resident in India if he is in India in that year for a period amounting in all to 182 days or more. This is point number one. In this case, he doesn't qualify for that. Then the alternative is people who are staying in India for less than 182 days. They do not automatically become a non-resident because clause C says having within the 4 years preceding that year, okay, amounting in all to 365 days. So to that extent, a person who stays in India in the 4 previous years prior to that year, he stays in India for 365 days and stays in India for 60 days. In that circumstance, also he will be a resident. Is that clear? Any doubts? I don't know. Is that clear?
Yes, sir.
This is very clear, no? A person who stays in India for less than 182 days do not automatically become a non-resident. He will become a resident. He will continue to be a resident if he stays in India for more than 60 days. And 365 days over a period of 4 years. So if you look at this second category, he is living for the first time on September 28th. So that means he has stayed for more than 60 days. Is that correct?
Yes.
That's no brainer. He is living for the first time means he has stayed for 365 into 4. Okay? So he qualifies under the clause C. So how can he become a non-resident? He will continue to be a resident because he comes under clause C of 6.1. I am spending so much of time because these are some of the fundamental things that I find many chartered accountants, when they address this issue with non-residents, they give an incorrect advice. That is the only reason why I want to spend some. These are all elementary things that we don't even have to discuss. And that is the reason why I have given examples. So let us quickly go through this. Even though he or she has spent less than 182 days in India, he or she will be a resident in India during that year, as he or she was in India for more than 60 days. That is the first rule of clause C. And having been in India for 365 days or more within the 4 years preceding that. Because he or she is going for the first time, they have spent 365 into 4. If there is a leap year, maybe one day less, but they have spent more than 365 days. So even in this circumstance, they will be a resident. There are 3 more categories, we will look at that. A leaves India for the first time on May 1st. Here answer is there directly, so to that extent less than 60 days, this is again a no-brainer. It will be a non-resident to that extent because less than 183 days, even if it's living for the first time, it doesn't matter. Even if they spend more than 365 days in the last 4 years, that doesn't matter because they come less than 60 days. Next, be an Indian citizen, okay, leaves India for the first time on August 1st for the purposes of employment outside India. This is very interesting. Now in this case, 60 days don't matter. Because if you look at clause C and the explanation below that, it says 60 days doesn't matter, 182 days or less. Automatically, because you are going for employment, you become a non-resident. And the returning scenario you have, which is very interesting. Indian citizen comes on a visit to India the next year on September 1st. So that means April to September is more than 60 days. Less than 182 days. So technically more than 60 days you are supposed to be a resident. In this case, in the case of returning Indians, they have given an exemption which says that 60 days gets substituted by 182 days So a person who comes to India, he can be a non-resident up to 182 days to that extent. And since this lady has spent less than 182 days, she will be a non-resident to that extent. She will be a non-resident in India during that year as he or she is in India for less than 182 days in that year, even though she has been in India for more than 365 days within the 4 years preceding that year. So these are the 5 scenarios I just want to explain how a person becomes a resident or a non-resident to that extent. These are not just fundamental concepts.
Sir, one thing, while calculating the days 60, 182 days, everything, the date of leaving the India should be included in.
One day will be included.
Acha, one side will be included.
Okay? Now you have this very, often you have this kind of a requirement of a US citizen green card holder. Today we have come to a stage where invariably there will be one person in your family who is a non-resident and that person would have gone to US. People who don't have people in the US are an exception to that extent, we can say that. So you have a US citizen, a green card holder residing in India for more than 182 days, more than 60 days, 365 days combination. They will also be a resident in India. It doesn't matter citizenship or green card. It's an individual. A person who lives in India for this number of days will become a citizen, will become a tax resident in India. Next, a person who is a US citizen green card holder who is a tax resident required to pay taxes on global income tax. We will look at specifically this category of individuals because you have certain very difficult or some interesting consequences for this kind of a people. So that's why I don't want to rush through this. I'm just going through at a slow pace. Even if I don't cover my presentation, it's okay, but let's have a discussion. Is it fair? I can proceed? You people are all awake, nobody is sleeping. Good. Now let us look at the reverse. I am particularly taken in the US because you have more number of people who go to the US than in other countries. And these are the cases which comes more often. So that is the reason why I have taken it. Not that I have any great fancy to US or to Donald Trump because we don't know what is going to happen in the future. But one thing I like about this country is the tax regulations are extraordinarily detailed. I have never seen any country's tax regulations as detailed as they are. Of course, it has its own complexities and things like that, but they are very precision oriented to that extent that they give a large number of examples. For instance, if you want to file an income tax return, a booklet to file an income tax return will be a minimum of 50 pages. That is the kind of precision and the details that they give. If India gives half of that, a large number of problems will be solved. And that is the reason why I specifically want to cover the US tax regulations. Now, determining US tax residency in the US for individuals particularly. At the fundamental level, you have 2 categories of tax residents in the US. In India, you have residents and non-residents. Like that, you have 2 categories. One of them is an exception category because in the United States, you pay taxes if you are a citizen. So you have 2 categories. One is a US citizen or a resident alien. This resident alien is a defined term, we will go to that. He is generally subject to US income tax on their worldwide income. If you are a US citizen, either by birth or by choice, you are subject to taxation on your worldwide income. That is a fundamental rule. The second is about a resident alien. If you are a resident alien, you have 2 categories of resident alien, so then also you become you are required to pay taxes on your worldwide income, regardless of where you live. That is very important. The moment you are a US citizen, whether you live in India, whether you live in Timbuktu or anywhere else, you have to pay taxes in the United States. So that is the toughest thing for a US citizen. That is the reason why there is a lot of agony and anxiety if you are a US citizen, saying on what income I have to pay taxes. A large number of Indians, when they go and become US citizens, they are not aware of this regulation. So you have a large number of returning Indians who are not even aware. So their concept is, I earn income in India, I pay taxes in India. I earn income in the US, I pay taxes there. I am compliant. Till they come to a person like me, where they wish that they have not met me, because I will tell them you have to pay taxes in India and in the United States on your global income. The impact may not be more in terms of a tax outflow because of tax credits, but there will be an impact. There can be instances. In fact, in one instance, I met one gentleman who came to me. He had applied for a US citizenship when he was in the US. When he came to India, he got his US citizenship. They were fairly good business people, so he chose not to go to the United States at all. And when he came and met me, it was almost about 5 years after he had come back to India, and somebody known to me had told him, why don't you talk to him, he's supposed to be an international tax expert. He regretted literally coming to meet me because in the United States, if you don't pay income tax, you don't file your income tax returns, he has not paid a single penny there, but he has earned a good amount of income in India. Now, when we computed his amount of tax liability, his tax liability in the United States, particularly because of penalties, was more than the income that he earned in India. He says, what do I do? So it's a very high cost of ignorance to that extent, because in the United States, if you don't file an income tax return, just like in India, you have a $10,000 penalty itself. That itself is a very high amount. And then the interest is also very high in the United States if you don't pay your taxes on time. So this is the reason why you have a large number of people who are not even aware that they have to pay taxes, and this is largely a misconception. I pay taxes in India on Indian income. I may or may not, because they don't have an income in the United States, they don't even file a tax return to that extent. Whether the US comes after them or not is a moot question, because today they have all the resources for them to trace you if they want, unlike in the past. And that is the reason why from 2012, when they introduced these regulations called FATCA, which is a Foreign Account Tax Compliance Act, the government of India has to share the details of all the tax US citizens, US tax residents live in India. And that is the reason why, because we have a minority population of US citizens or US tax persons residing in India, we all have to make a declaration that I don't have anything to do with US. This is ridiculous. We have a small population. Because of them, I have to make a declaration that I am not a politically exposed person, I am not a citizen, I don't have to file my income tax returns in any country other than India. This is something that all of you must be familiar. Why is that in the past we never used to make a declaration? Today, because they want to trace this. And based on that, the fact that you say that you are supposedly a tax resident outside India, then it will be tracked, and to that extent, if you are US related, it will be shared with the IRS. It's a different matter that you may say that I don't know, I am not a tax resident outside India because of ignorance. That's a different matter. So you have this particular regulation only because for people to be traced. Tomorrow, if they want to cash hold of you based on certain parameters, it is possible. It's not that it is not possible. It might not have happened for you. That doesn't mean it may not happen in the future. That's the way I look at it. But anyway, these are all the consequences of ignorance. So you have a US citizen or a resident alien, and then today a person, individual is a non-resident alien if he is either not a US citizen or is not a resident alien. Now, what is this resident alien? You have two categories of resident alien. One of the categories that all of us are familiar by nomenclature is this called green card holder. The second category, just like in India, you have a substantial presence. So you have, for instance, if you are there in the United States, first rule is 182 days, just like we have in India. Unlike 60 days, we have 31 days concept in the US. And unlike this 7 years, 9 years, 4 years, you have a different computation to that extent. So you have 3 years before that year based on full number of days, and then 1/3 and 1/6. So that's what you have. So you have literally 4 categories of individuals in the United States for income tax purposes. You have a US citizen, there is no computation. The moment you are a US citizen, you are required to pay taxes in the United States regardless of where you earn an income, regardless of where you stay. That is a fundamental rule. The second is a green card holder. A green card holder is considered to be a lawful resident of the permanent resident of the United States. So he is an equivalent, he is a cousin brother of the US citizen to that extent. So he also has to pay taxes in the United States on his global income. The third category is a substantial presence. So you have a large number of Indians who live in the United States who don't have a green card because they are on a H1B L1 and they have been living for X number of years there. They will be a resident alien because they have stayed for more than 182 days. The fourth category is a non-resident alien. Generally, there will be people who go for short periods of time, or in the year they go to the US, or the year they come back from the US, because they stay for less than 182 days. So you have four categories of individuals in the United States. Unlike in India, where we have three categories, and the only difference is in India we don't pay taxes because of citizenship. In the United States, we pay taxes because of citizenship. Incidentally, US is the only country in the world which requires its citizens to pay taxes. And the consequences are very, very high, that the number of people who are giving up their citizenship is high over the last about 4 or 5 years to that extent. If you go to many of the European countries, the moment you say that you are a US citizen, the bank doesn't even want to open a bank account. Here at least you will not come to the stage. I do not know how many of you invest in mutual funds. There are some mutual funds which say that they ask you to make a declaration whether you are a resident of US or a citizen of US or Canada. The moment you say, some of the mutual funds don't want to take your investment. So you have consequences there. The other issue is, if you want to give up your citizenship, also there is an exit tax if you have assets worth beyond about $2 million. So to that extent, there is a cost of giving up your citizenship also there, but they are all just for information. For tax purposes, these are the requirements. So you have one set of regulations in India, you have another set of regulations in the United States. Just like we saw the example in India, let us look at the example in the United States, how it is determined. Now let us take an alien is physically present in the United States for 122 days, 120 days in each of the years, just as an example, 21, 22 and 23. How do you determine? To determine the substantial presence test for 2023. Here it is 3 years before, in India it is 4 years before. Count the full number of days of presence in 2023 for that particular year. In India you go back 1 year and do it. In this case you do it for that year. You count the complete number of days, 120. 1 year before you count it for 1 by 6. 1 year before that you count it for 1 by 3. So here the rules are fairly simple. So if you add up all of this, it comes to 180 days. Because you are there for 180 days, you are a non-resident because you don't meet the requirements of 180 days. So this is another simple example. Now this is the immigration status versus tax status. A US citizen is also, tax status is a US citizen, pay taxes on global income. Immigration visa holder such as green card, he is a resident alien, he comes under the category of resident alien. Substantial presence test more than 182 days, you are a US resident alien, less than 182 days, you are a non-resident alien. I have one small question. What is this, how do you identify, or what is the description of a US green card holder? What do you mean by US green card holder? Let me just ask if any of you are aware of it.
It's a permanent residentship card.
Permanent resident?
Residentship card. Permanent residentship.
Okay, that is fine. Anything else? There is one particular thing that I am looking for. That is correct. What you said is absolutely true. Sorry? Okay, my good.
They are on path to naturalization in a few years to acquire citizenship. So maybe their tax status would change in a few years by they become a citizen.
Do you have to necessarily be a green card holder to become a US citizen? Based on your question,
I'm not sure of that yet.
you don't know. Anybody else? How do you identify a green card holder?
the person who is having a unlimited visit access for
No.
US?
No.
He is not born in the US.
No, that's okay.
Married to a US passport.
Huh?
Married to a US citizen. Immigrant visa.
He says a green card holder will have a US passport. Okay, anybody else? I'll come back to you. You are very close. It is actually the reverse. A green card holder, particularly an Indian who is a green card holder, has an Indian citizenship. He has an Indian passport. He does not have a US passport. Only an American citizen has a US passport. That is the reason why. These are not tidbits, these are no consequence of taxation, but it's very important to understand. A green card holder, just like a resident alien, if he's an Indian, he will have an Indian passport. If he's a Britisher, he will have a British passport. If he's a Chinese, he will have a Chinese passport. There's a huge population of Chinese in the United States. That's the reason why I'm talking about Chinese. So this is very important. He has their country passport, not a US passport. It's only a US citizen who has a US passport to that extent. This is just a tidbit, it doesn't matter.
Is this the only reason?
Sorry?
This is the only difference between a green card holder.
Correct. Correct. Otherwise, it's all the same because for you to get a green card holder, you have to reside in the country for a certain number of years. So by that definition itself, you become a resident because you would have stayed for more than 180 days. There's absolutely no other difference, except that you don't get the privileges that some of the US citizens get. That's a different matter. As a citizen, you don't get that. That's okay. But for all practical purposes, particularly for liabilities, you are like a US citizen to that extent. Okay, but if you are an Indian citizen, that is the reason why you have green card holders also coming under the category of PIO or OCI. PIO is what was originally called the persons of Indian origin, and then they changed it to overseas citizen of India to that extent. And if you are in these two categories, it's easier for you to come to India. You don't get any privileges because of this in India. But yes, you are an Indian citizen, so to that extent you get the privileges of being an Indian citizen, particularly if you are in this war-torn areas and things like that, then there will be that much amount of scrutiny and you get the benefit of being an Indian citizen. So you don't get the right to vote unless you come here. So that is also there. You don't have a postal voting in India yet. So to that extent, if you are an Indian citizen having a US, you still are entitled to vote. Except that because you don't reside in India, you don't have an address in India, and that's a permanent address for you. So that will be again a challenge for you to exercise. You are eligible for exercising of vote, but the practicality of that is very difficult unless you have an Aadhaar card, you have a house here which you are given it on rent, and then if you want to claim on that basis, you can do. You don't yet have a postal voting in India. Okay, so this is what I said. They is the only country since 1930, more than 100 years old. This is legislation, and they have no intent of changing this at all. So to that extent, they want to continue to tax US citizens to that extent. Now, taxation of income of individuals in the US. Just like we talked about the taxation of India, we have a couple of things. The Internal Revenue Code, which is the Income Tax Act in the United States, divides income into two categories: domestic source income and foreign source income. They are very clear about that, just like we have in India also. Now, income from sources and foreign source income. Sections 861 to 865 of the IRC describe the rules for determining where the income, because we talked about foreign income and just touching upon this concept of income. Okay? Of the rules, whether the income is in the US, source income or foreign source income or federal income tax. I am only talking about federal income tax. In the United States, you have three kinds of taxation, three kinds of income taxation. You have a federal income tax which the government of the US will take. Depending on the state where you live, you will have a state income tax. Depending on the city you live, you have city income tax. There are many states, there are few states which don't have a taxation regime to that extent, so you have a zero tax. Many Indians live in Texas where there is zero tax to that extent. You have very high taxes, particularly in New York and California, both you have a state taxation as well as your city taxation to that extent. So you have three kinds of taxation particularly. So if you look at whatever I am going to talk about is only about the federal taxation, I am not touching upon the state taxation at all. So 861 basically lists specific types of gross income that are treated as income from sources within the United States, and section 862A gives the reverse of foreign source income. In India, the problem that we have is we have a catch-all phrase. What it says, income accrues or arises or deemed to accrue or arise. This deemed to accrue or arise is something which is extremely dangerous. Anything under the sun is deemed to accrue or arise. That is where the problem is. Okay, or received in India. Again, you have the conflict whether there is always a fear whether what is deemed to accrue or arise, when you receive you have to pay taxes. Even though there is a clarification that says that you don't have to pay taxes, there will be certain instances where the income tax officers may want to tax it at the time of receipt if it is a very high payment. So you have to go and explain all of those things, so you have. Whereas here they have specifically identified sources of income and where it arises to that extent. So there is a little bit more ease in identifying this. Now again, like in India, you have US citizens and resident aliens. Resident aliens is both green card holders and people who have spent more than 182 days. They are taxed on their income from all sources, whether from within or outside the United States. Just like in India, resident in India is being taxed on global income, they are also being taxed in global income. And the non-resident aliens only on the amount received from sources within the United States, just like we have in India. If you are a non-resident, you don't have to pay taxes in India on the income. You have to pay taxes in India only on the income that you earn in India. Outside India, you don't have to pay taxes, as we saw in the definition of income 456 that we saw, section 456.
Sir, one thing, the persons who are going for study purpose, what will be their status? It will be the same test?
They will be, but then they will not have an income to that extent because they are going on student
They are
visa.
allowed to do some part-time or number of hours. So the income tax will be the same.
That income tax will not be so high for them to pay taxes, but literally they are a resident alien because they want to stay, so they will have to pay taxes.
And there can be the cases that you are the Indian resident as well as you are the resident alien of USA. Both. And you have, in both the scenario, you have to pay the global taxation for each country, in each country. Then
You repeat?
I am saying there can be the scenario,
Yeah.
you are staying into India for 182 days. You have come to India for a visit. You are a resident alien of the USA. You have come to India for stayed for 182 days and then you return to a USA. So in that scenario, you are the resident Indian also, and you are also the resident alien of USA.
That generally doesn't happen for resident Indians.
But
Because the fact that you are on 182 days, you calculate in the United States, you have to do for 3 years.
so there.
Okay, so you are saying that if you come to India, not just 182 days, you can take an exemption because you have to see the number of years, number of days that you have spent the previous years. So you are unlikely to be a resident in India and in the United States.
Why, sir? Because
In India, 182 days is there. Okay, that is fine. But you also have an exception where for the X number of years you have to calculate on that basis. But there is a possibility that you can be a resident in both the countries to that extent.
So in that scenario, when you are you have to file the return based on the global income for both the countries.
Actually, the reverse happens. I will come to that. It's there. I will come to that. Okay, I have a specific issue with that. Okay, they are called dual tax residents. Okay, this kind of individuals. It happens more for US citizens, basically because US citizens number of days doesn't matter. Okay, the moment you cross 182 days in India, you are automatically a dual tax resident because in the United States anyway you have to pay tax.
Expats are coming on.
Okay, so to that extent you will have a issue of a US person or an Indian person who has a US citizenship becoming your dual tax resident. I talked about the incident of that person. That person is a dual tax resident in India. Because he lives in India for more than 180 days, he is a resident of India. He is a tax resident in the United States because he is a citizen of India. The reverse possibility is very limited, but it is possible. the number of instances of Indians becoming resident there in India is very, very limited.
So both the countries will give like credit for their taxes.
I'll come to that. Yes, they will. The top answer is yes. Okay? Now, this is the US source rules that you have. Okay? One of the questions which is often asked is, what happens to employees? When they go to the United States, they come back very often, what do they pay? At the end of the day, so far as employment is concerned, by global tax principle itself is very simple. You pay taxes where you render services. Okay? You have all kinds of situations where you are rendering services to multiple countries from one particular country. Your expenses is charged to various countries to that extent depending on what kind of employment structure that you have. That's a different aspect. But the primary rule for taxation of rendering services, let me put it that way. There are two kinds of situations where you get taxed for rendering services. You render services as an employee, in which case, wherever you are exercising your employment, physically you will be taxed there. So you have these two scenarios. I do not know how visible it is. Salaries, wages and other compensation, where services are performed. This is salaries. Okay? Next, in the United States, you have a combination just like in India, business or professional income. Okay? Income from trade or business, as it is called, business, trade or business. So to that extent, you will have both of these. So if you're providing personal services, like for instance, like me, if I'm a private consultant, I'm providing personal services, I'm not running a business, so where services are performed. In the case of business, you have two kind of scenarios. You will have where sale of inventory, you sell goods. If you manufacture and sell goods, you pay taxes where it is manufactured. If you buy and sell goods, you pay taxes where it is sold. So these are all some broad parameters that they have very clearly for taxation of income to that extent we have given. For instance, dividends is very interesting. In the case of dividends, you pay taxes. If you are a domestic company in the US, you pay taxes in the United States. If it's a foreign company, for instance, if it's a Indian company where you have invested and you receive dividends, you pay taxes in India to that extent. Except if you are a owner of a company of more than 25%, then it will be considered to be a US company, so you pay taxes there, so there will be double taxation to that extent. Dividend is a aberration to that extent. Again, interest you have, and then very clearly you have regulations there which talks about a 30% withholding is a standard. Based on the India-US treaty, the rates may come down to that extent. So these are the broad parameters of US source rules. The reason I am talking about source rules is it's very important to understand where the income is getting generated for you to avoid double taxation. This gentleman talked about a person who is an Indian who becomes a resident in India and in the United States. This sourcing rules is extremely important for you to determine where you have to pay taxes. If you are receiving, for instance, if you are receiving income from the United States, the primary source of taxation is the United States. The fundamental rule in international taxation is you pay taxes in the country where you earn. So that is the reason why this source rule is very important. If you earn in India, you pay taxes in India. If you earn in the United States, you pay taxes in the United States. We will look at some conflicts there, but the importance of source rule is basically to see where you are earning income. If you are earning income in the United States, you primarily pay taxes in the United States, you take a credit in India. If you are earning in India for a dual tax resident, if you are earning income in India, you pay taxes in India first, you take a credit in the United States after computation. So these are the fundamental rules.
These rules is only for the non-resident aliens?
No, for all, everybody. This rules is important for you to determine where you pay. Whether for residents also. Dual tax resident, you will have an issue because you are paying taxes on your global income in two countries. Whether you are a US citizen or whether you are an Indian citizen, it doesn't matter. If you are a dual tax resident, what does it mean? You are required to pay taxes on your global income. Is that correct? In both the countries. So which country will you take credit? I am asking you a simple question. How do you determine?
For the purpose of determining the tax rate.
Correct. No, where will you primarily pay tax? See, in the case of taxation, you first pay taxes in one country and you take credit in another country. When you are taking credit in the next country, you don't pay taxes. Okay? So this source which is primarily important for you to determine where you are required to pay taxes. So under the circumstances, if you are, let us assume for a moment that you get dividend income from a company like Infosys with whom I was employed. Okay? You are in the United States. You are a US resident. Where will you pay taxes? You are receiving income from India.
Yes, sir.
Where will you primarily pay taxes? Where will you take credit? I am asking you a simple question.
If you are a resident of the US state,
Yes, you are a tax resident of the United States. You are getting income of dividend income in India.
so even if the income is the foreign source income, if you treat it as a foreign source
It is a foreign source
if it
income
is
in the
foreign
United
source
States.
income, then also you are supposed to pay being a tax resident of the
Correct. Where will you primarily pay tax is a fundamental question. Where will you take credit?
If you are resident of India,
No, you are a resident of the United States.
only US.
Correct.
So then only in US.
No. You will pay taxes in India under the TDS. TDS will apply. 10% it will apply. You will take credit in the United States. Why should India lose revenue? Because you want income from an Indian company which is doing services in India. Whether it's a manufacturing company, whether it's a service company, doesn't matter. If you are a tax resident in the United States, you have to pay taxes in the United States on dividend income. But India has the right to tax. So India will do TDS. You will take credit there. So you won't pay taxes in the United States on the income that you have. You will pay taxes on a difference. That's a mechanism computing. I am not come to that. I am asking you primarily why you are looking at sourcing rules is under international tax concept, you will pay taxes in the country where you earn. You are earning dividend income, you pay taxes. That's very clear. That is the reason why I am emphasizing on sourcing rules. This is the second concept in the flyer which was circulated. Is it clear or is it too confusing? Is it too intimidating? I want to know. Because I keep on talking about it, I don't know what your reactions are, what your understanding is. The more questions, I am very satisfied.
Okay, so I have two clients,
Yeah.
both of them US citizens.
US citizens,
US citizens, non-resident in India.
non-resident in India.
Yeah. So, both of them Indian, but now non-resident because being a US citizens. So one of them has sold an asset in India. Yeah. So on that, I was saying that I need to pay the capital gain tax in India
Absolutely.
because of
Why? Why do you pay capital gains tax in India?
location of property. The source is in India.
No, why did you say so in India?
Because property location is in India.
Brilliant. So property is located in India. You are selling property. Either you are getting rental income or you are selling capital gains you are getting. You have to pay taxes in India. Absolutely correct.
Now,
Primary is India.
primary is India. Now, because they are the US citizens, they are taxable on the global foreign source income.
Correct.
So that means they have to tax.
They have to
will be taxed.
offer this income to the US.
Yeah, offer the income, but the tax what they pay here will get the credit in the US.
Absolutely.
That's how it will be.
That is correct.
Now, the same thing will apply for the other one as well who has the mutual fund income in India. Yeah, again non-resident, again citizen. So that means the tax will be paid in India and the credit will be offered when they are offering the income there. And
Primarily, yes.
yeah, primary yes. And one capital gain mutual funds, and the third one was related to a person who is having a salaried employment here. Now, my understanding was that when this is just a clarification when I'm saying that principally where the services are performed is where the tax has to be paid. But then should I extend as well that the income which the employee earns in India as an employee, US citizen, would also have to offer this income in the US as well and take the tax rate for salary.
So far as US individuals are concerned, if they earn foreign source salary income, there is a separate mechanism where they don't have to include this and tax it there.
Okay.
There is a separate only for salary income. Okay, for exclusion. That's okay. But everything else you said is correct.
Okay, so I think it was salary was also important because quite a few of
Yes, you have to
them
pay
are
taxes there.
citizens and OCIs and who are working in India.
Correct. You have to pay taxes in both of them.
Because nowadays what is happening is a lot of the multinationals or the Indian startups are sending their
Mike, what is? No, I want everybody to. I can hear you, but I don't know whether others are able to hear you.
yeah. So this is a practical thing which is happening now, big time, and it will happen more and more because of the salary differential between US and India. A lot of startups, the Indian startups, are requesting their employees to come and settle down in India. They will try to kind of give them the differential of wages, but they are the OCIs or the citizens or the resident aliens who come here in India, who will be earning the salary in India, maybe in the Indian company or a US company, but whatever the source is in India, they'll pay the TDS. So this is a practical thing which is happening more and more now because of the wage differential. So I think this was practically very important for me.
There are some challenges. Okay? Now, if you are a US citizen or if you are a US person, okay, whatever, if you are working in India, generally they will give two types of salaries or they give two kinds of salaries. They give you salaries in India for you to take care of your expenses in India, largely. Okay? In parallel, they will also pay you salaries because you would have your EMIs there. Every American has a liability, including the government. The government of the United States is the biggest debtor in the world. That's a different matter. So they will pay. The problem that I find in many instances, the salary which is paid in the United States is never getting taxed because it is not even being declared. That is another issue. Technically, you are being paid salary. Wherever you are being paid salary, if you are rendering services in India, you have to pay taxes on your global income even what you earn there. In many instances, it does not even get reflected. Hopefully because of ACTA regulations that gets traced, but I don't know about that. So I am just adding another layer saying that if you get salary in two locations, technically you have to pay taxes on your global income, and that income also has to be declared and pay taxes to that extent.
Okay, this is also a practical thing which again I came across, in which the second part was the one where the person said that while I have been transferred, but to support my other expenses in US, I will be paid salary in US. Now, because he's based in India, so that means it will be income deemed to accrue and arise in India.
Absolutely.
Because the person is using the technology and the place of location from
So
there.
there is this issue about how you draft that employment. So they will draft it in such a manner that you are providing rendering services to both the locations or something like that. But it's a matter of litigation. The simple answer is you pay taxes in India, take a credit there.
Yeah. There was another extended part which was again asked by one of the
Don't
citizens.
maneuver the regulations to that extent because it's costly. And Indian tax authority is also going after them. Today it's possible to trace. Very clearly it is possible to trace. Sorry, one second, let me finish.
Yeah.
Let me finish. One second.
No, I think there was a third extended example which was again asked by one of the client who is a US citizen, now resident in India. His point was that there are incomes which he earn on the pension kind of funds, the US pension funds. So what would the treatment will be in India? My thought was that okay, it is again a global thing, but then because the source is there in US, possibly you may not have to tax. So I just want to check with you, what would my answer on that?
See, in the United States, you have what is called a social security system.
Yeah, that's the one, correct.
Social security is a payment made by the government.
Mm.
Okay, there are two kinds of payment or three kinds of payment. So, social security is exempt from taxation in India. If you get social security payments, it is exempt from taxation in India.
That's a good point.
If you get income from 401k, okay, then you will have two kinds of scenarios. 401k is taxable in India as part of global income. But the issue that you have, see, one of the biggest challenges that you face in global income taxation is, you talked about, first I'll come back to this, but before that you talked about capital gains. You sell an asset in India. Very often you will have instances where they have been advised by chartered accountants saying, if you invest this money into another capital, land or any of those capital gain schemes, whatever, you have multiple schemes, even now under the new regime, you are exempt from paying taxes in India. While you are exempt from paying taxes in India, you still pay taxes in the United States. That a large number of people forget. Okay? So what is exempt in India need not necessarily be exempt in the United States, and that is the reason why you will have a double taxation. That's point number one.
Now, this was also a very important scenario which happened for one of the client where he sold and he got the section 54F exemption, but the point was that
It's
whether
ridiculous. Okay? So you pay taxes in both the countries. The second scenario that you're talking about, 401k. There are two kinds of 401k in the United States. One is similar to PF. In India, when you contribute to PF, you are exempt from taxation. Your employer is exempt from taxation. Of course, so lastly, when you get back that money also, it is exempt from taxation. In the United States, you also have a scheme where if you contribute to a 401k, okay, which is exempt at the time of contribution, whatever income that you get from that is taxable at the time of receipt. It's a deferment of income tax. Okay? So if it is taxable there, it is taxable there, it's okay. You have another scenario which is a PPF kind of a scenario. In India, I earn my income on which I pay income tax. I invest that money, like your ELSS schemes, I invest that money in a PPF scheme, which is a debt scheme. When I invest, I get exemption. The interest is exempt and then the receipt is exempt. In the United States, the equivalent of PF, if you contribute, again when you get back that money, it is exempt. What happens in such circumstances is you are exempt from taxation in the United States, but you have to pay taxes in India on that income. Large number of people forget that. We include that. That's another challenge. So 401k depends on the kind of scheme that you have. You have the Roth 401k, which is exempt from taxation. You have a regular 401k, which is subject to taxation at the time of receipt. Social Security payment is exempt because it is paid by the government. All of these things, other things are paid by private entities, just like you have a mutual fund in India.
No, okay. So one point, I think this 401k is something which is a lot of thing debated
It is
between
not
the.
debatable, it is taxable.
No, not debatable in terms of whether it's wrong or right, but the CAs are struggling with that. My only question is the way you explain.
So you go to the wrong CA, you have to come to me.
Yeah. So the point is that is there any guidelines which is published by the institute to
This
this?
doesn't even know about it, they don't have to know about it, it's not their job. They are expecting too much from the institute. I'm sorry, because it's not their job.
But by the income tax, because yeah.
At the end of the day, the rule is very simple. What is exempt in one country need not be exempt in another country. You have, for instance, municipal bonds in the United States. Just like you have ELSS schemes in India. Okay? You have municipal bonds in the US where interest is tax free. If you are an Indian resident for whatever purposes, that interest is taxable in India. It's a different matter than many of them, because it's exempt there, they don't declare. That's ignorance. The amount may be small, it may be medium, it doesn't matter. Principally, it is taxable. Global income means every penny that you get is taxable in India. Similarly, every rupee that you get in India is taxable in the United States. You may not pay taxes in India because it's exempt in India. You may not pay taxes in the US because it's exempt in the US. And that is the reason why source rules are very important. Primary thing in taxation all over the world is source country, you pay tax. The country has the right to tax. Whether it is salary income, whether it is interest income, dividend income, it doesn't matter. The residence country always gives you credit. So that is very, very important, particularly in the scenarios of dual tax residence. Okay? There is something which is very important that I want to highlight when you talk about mutual funds. A large number of people are not even aware of this. A mutual fund in India, I will not cover any of these things because you are asking me this question and we just...
No, this is helpful for me.
No, it's helpful perhaps for everybody. You are already at 7:30, so it doesn't matter. In the United States, they want to pay tax every year on the income. Okay? In India, it need not be so. And that is the reason why they have a very prohibitive regulation called Passive Foreign Investment Corporation Act, PFIC. This regulation was introduced in 1986. Okay, 50 years old, almost. 40 years or 42 years. Okay? This regulation says, if you are investing, if you are a US person, either a citizen, green card holder or a US tax resident, if you invest in a pooled fund outside of the United States, okay, you have to pay taxes under 3 schemes. The first is, you should ask your mutual fund to give you the list of all the capital gains that they have generated. Dividend income and investment and interest income. All the gains that the mutual fund has made, you have to give them a list. No mutual fund in India will give you. Why should they give? Because they are exempt. So you don't qualify under that. The second option for you is, you take the difference between the NAV at the end of the year and the NAV at the beginning of the year. So that gives you the appreciation during the year. Okay? Please listen to this very carefully. This has very punitive impact. Okay? So you take the difference between the NAV at the end of the year and the beginning of the year. If there is negative, you can take it, adjust it in the next year. Let us assume that you have invested in a growth option of an equity mutual fund. Okay? In India, if you look at a pooled fund, particularly such as a mutual fund, that is the best source of income and investment for any individual in India. Okay? There is no history that you have made loss over a period of 7 years. Provided you stick to that investment, you don't withdraw. Now, how does a mutual fund in India operate? A equity mutual fund growth option means you will pay taxes. Today you have a very unique structure which a lot of people don't even know about. Mutual fund is the only entity in this country which doesn't pay taxes on capital gains. They don't pay taxes on capital gains. What does the mutual fund do? It buys securities, it sells securities on a daily basis. They will have long-term capital gains, they will have short-term capital gains. They don't have to pay taxes in India because they are exempt from taxation. They don't pay. That is the only entity in India which doesn't pay taxes, particularly on capital gains. This is dual benefit. Because it doesn't pay taxes, whatever they generate is reinvested. So you get the benefit of compounding. That is the reason why an equity mutual fund growth option is very good, because whatever money that you get back, you are investing. Supposing you have shares, for instance, when you sell shares, if there is a gain, you pay taxes, whether under a portfolio management scheme or in your own individual scheme. Every person has to pay taxes. The only exemption is a mutual fund. So you get tax protected gain till you sell the units. The United States doesn't like, because in the United States, if you are a mutual fund investor, you pay taxes under 5 categories. This is very interesting. A mutual fund is a taxable entity. It's not a taxable entity in the United States. It's a pass-through entity. So you will pay taxes in the United States as an investor. So whatever income earned by the mutual fund will be passed on to you. Okay? In India, you pay long-term capital gains depending on the period of your holding. Let us assume that you buy at the beginning of the year. In this kind of a scenario where there is a lot of volatility, you sell within 1 year. You will pay only short-term capital gains at a higher rate. In the United States, even if you have invested for less, let us assume that you invest in the month of February, in the month of September or October. December you have to pay taxes. It is possible for you to pay long-term capital gains even though you have invested for 3 months, because the mutual fund has generated long-term capital gain. So in the United States, if you are a mutual fund investor, you will pay long-term capital gains, you will pay short-term capital gains. This is all the gains made by the mutual fund. Okay, it's not on your gain. The mutual fund would have won dividend income, interest income. So you have 4 sources of income. Next, if you have sold your units like in India, you will have your capital gain depending on the period of holding. So you have 5 kinds of taxation there, 5 kinds of income, of which long-term capital gains is taxed at a lower rate. If you invest in India, that long-term capital gain benefit you don't get. That's point number 1. Okay, that is if you calculate. 95% of the people don't even know about this regulation. So they don't pay taxes on a yearly basis. If they don't pay taxes on a yearly basis, let us assume after 5 years you sell your units in India, you have made a good amount of money in India. Okay? You sell it. You pay taxes in India at 12.5% now, earlier it used to be 10%. In the United States, you have to distribute these gains over 5 years. First thing. Okay? You don't get the benefit of capital gain taxation. You pay taxes at the highest marginal rate, which is 37.5%. You pay taxes in India on that income at 12.5%. In the United States, you pay 37.5%. Point number 1. You have not paid taxes for the previous years. You pay interest and penalty on that. The interest and penalty is somewhere around 7 to 8% per quarter. So please remember, for 4 quarters into 5, 20 quarters, you pay taxes at 7%. Literally 50% of your gains is gone if you invest in Indian mutual fund. 95% of the people don't even know about this regulation. In the United States, CPS don't know about this regulation. Okay? I had spoken about this in 2012. So today, there are some people who are possibly aware. So when they come to it, it's very punitive. 37.5% is ridiculously high taxation for capital gains that you pay. You don't get that benefit. This comes under the P5 taxation. I'm just highlighting to you because it's useful for any of you where you are going to have clients with your source income.
No, but
That is the reason.
we talked about that capital gain, that is
Sorry?
realized. It's a realized capital gain.
Come again?
When we talk about the capital gain in US or whoever the
Yes.
in mutual fund in India, they have to pay the tax on the realized capital gain,
Correct.
not at that unrealized.
No. So in any case, a mutual fund, whether it is in India or in the United States, they will buy and sell every day.
Correct.
So they will have capital gains during the year. So on that income, you have to pay taxes because it's a pass-through income. But in India, the same thing doesn't happen because the Indian mutual fund is exempt from taxation and the Indian mutual fund is not a pass-through.
No, what I'm asking, suppose in a January he invested $10,000.
Huh? Okay.
And
No, where?
end up
In the United States.
In India.
Okay.
Any that US citizen invested in a mutual fund in India and 1st January with the value of $10,000.
Okay.
And year 31st December, his value is $15,000,
Okay.
but not realized.
Correct.
So for $5,000,
He has to pay taxes in the
in
United
US.
States.
Yes. And suppose the next
There are
year
two
is a
consequences of that. I'll come to that. Yes. So he has to pay taxes not in India because he has not realized the gain. He has to pay taxes on the $5,000 in the United States on the unrealized gains.
and next year again
So
suppose
when you pay that $5,000, you don't pay a capital gains rate. You pay at your income tax rate. So that is the second issue. You don't get a capital gains benefit because you are not paying taxes as per the US methodology. Okay? You are paying taxes on notional income. So there you don't get a capital gains rate. You get rates taxes as per your income tax rate. It is still lower than the highest marginal rate. That is the only relief that you have, provided you are aware of it. Now the impact of this is, you are paying taxes on notional income. You don't get credit because you are not paying taxes in India. In the year in which you sell, you are paying taxes on the whole income. So that's okay. You don't get credit because you will get credit only for the differential from the 1st of January of that year to the date of this. So the amount of taxes that you pay will be minuscule. The amount of taxes that you pay in the year of sale will be higher. So you will have a double tax impact and also you have the impact of a higher rate because you don't pay capital gains tax in the United States.
so means here suppose end of that 31st December, the value was the 15,000. On 5,000, he has paid that the tax.
You will pay taxes on
And
his
next
income tax
year,
rate.
yeah, and next year he sold that at the $12,000 only. Means only that $2,000.
Okay. So for the $2,000, to that extent in the United States he will pay, he will get a credit because he sold it at a loss in the United States. Because he has already paid taxes of
Correct.
15,000, he is now realizing only 2,000, so he will get capital gains benefit there. But in India, you will pay taxes of 2,000
Yes,
equivalent
yes,
rupees
yes,
to that extent.
yes.
So you don't get again the double tax credit there because there it's a loss, here it's a profit.
Okay.
So you will have those challenges, particularly if you invest in mutual funds by a US resident. If you invest in shares, it doesn't matter because you will anyway pay taxes when you buy and sell under the PMS option.
Okay. Thank you.
Are there any exceptions to this, like index funds or exchange?
It doesn't matter.
The PFIC rule will apply for these also.
Anything that you invest in India, whether it's an active fund or as a passive fund, it doesn't matter. You have to pay taxes on the difference. The index fund also buys and sells securities on a daily basis. Except that they calibrate it on a particular period. But yes, you have to, whether it's passive or active fund, it doesn't matter. It's a pooled fund.
Right. How does one solve the problem of cash flow, right? If I bought something for 10,000 and that became 20,000.
That's your problem, it's nobody's issue. You have bought it, you have to be aware of it, avoid it.
The tax which you pay there in the US, is the credit available in India?
No, if you are a US citizen, you will get credit there, not in India. So you pay taxes first year, you take credit there.
So sir, now that one more question, because nowadays that most of that our the demat, they allow you to open the demat in US and we can buy and we can sell the shares.
If you sell it, if you buy and sell in the US, it doesn't matter because anyway you pay under their regulation. I am talking about investment by a US person in Indian mutual fund.
No, yeah, that is fine sir, but this is the question. Because suppose if any of that invest in US stock and sell there, so that that person need to file their tax return there?
If it's a US citizen or a US person, he has to pay.
Indian citizen.
Indian citizen, yes. Capital gains is exempt from taxation there for an Indian person. US capital gains is exempt from taxation in the US. But if he is a tax resident in India, he has to pay taxes on the global income, so to that extent he has to pay.
In India?
In India.
Okay.
You are invested in a Microsoft stock.
Yes.
Okay? You sell the Microsoft stock for a fancy amount. Okay?
I wish.
Okay? I hope it comes true for you. May not be for Microsoft because it doesn't give as much as Nvidia, but that's a different matter. So in India, you will pay taxes on that income. In the United States, because you are a non-resident in India, you are not required to pay taxes on capital gains, but on interest and dividends, you have to pay tax.
Okay. Thank you.
So I have one more related question.
So you have got from taxation to investment now. Very good. But I hope all of you people are finding it interesting. That is the reason why I have come here. It doesn't matter about my presentation.
So if it's a US person residing in India, which means
Residing in India.
a
Okay.
US citizen or a green card holder, and being in India for a long time, he's invested in a startup or he's got his own company, and that company's value has increased over a period of time, right, because of the growth. Does he have to report that also?
That's not a pooled fund.
Yeah, it is
No,
not.
so you don't have to. You don't have to pay taxes if it is an investment in a direct company. Whether it's a startup, whether it's a listed company or anything, it doesn't matter.
So
What I talk about PFIC is only for pooled funds. The basic example is, the primary example is only your mutual funds. It also applies to insurance funds also. That's complex, so I don't want to touch upon that.
like units, you mean?
Yes. Because that's also a pooled fund.
So is it safe to say there's a workaround to get around this for US persons residing in India wanting to invest in a mutual fund is to form a company, put the funds there and then let that company invest in a mutual fund?
Okay. But then that will result in lower taxation for you. You will have to pay taxes there. It's a cumulated yes, but yes, you can.
Thanks.
Sir, can you just explain about the NRE or NRI account for the persons who are not resident?
Okay. In India, okay, since this Fire talked about FEMA regulations, we also have FEMA regulations for residents and non-residents. Just like we have a concept of resident and non-resident in India, under the Income Tax Act, which talks about 182 days and various other regulations. FEMA also have a resident and a non-resident category. The primary difference is in the case of income tax, this 183 days is calculated for previous years. So it is calculated, let us assume for 24-25. Under the Income Tax Act, the residency rules applies for years before 24-25. 24-25 will be your previous year. For calculation purposes, you always take the year before 24-25. In the case of FEMA, it is calculated for that year. First thing is, there is 1 day difference, 182 days, 183 days. So these are the two primary differences of residency. The third thing which is extremely important is, residency under FEMA is basically based on intent. If you have an intent to live in India for an undefined period, you are considered to be a resident. If you don't know when your residency is going to end or for how long you are going to stay, then you are going to be a non-resident. So first is you have to determine whether you want to be a resident or non-resident. It is safe to assume that if you don't know when you are going back, it is better to assume that you are a resident. That is point one. All residents like you or me can have only a savings bank account. If you have a businessman, you can have a current account. These are the primary banking regulations. If you are a non-resident, which is again a misnomer or a thing which a large number of chartered accountants don't know, a non-resident cannot have a savings bank account. It's illegal. Let me repeat. It's illegal for a non-resident to have a savings bank account.
You can make it converted.
It gets automatically converted to an NRO account if you declare that you are a non-resident. Many of them don't declare. Many of the banks, even if you declare, they open a SB account. That's a different matter. Okay? By law, under the Foreign Exchange Management Act, if you are a non-resident, you can have NRO account, NRE account. I'll come to that. If you are a resident in India like you or me, you can have only a savings bank account. If you have a business, you can have a current account. Okay? You and I cannot have a NRE, NRO account. Now, one second, I'll come back to it. Now, in the case of a NRE account, it is funded by foreign investments. So whatever money that you earn outside India, you can put that in an NRE account, you can take it back. Okay? In the case of an NRO account, whatever you earn in India has to necessarily go to an NRO account. NRO account has a limit for withdrawal. This is 1 million per annum. LRS is applicable for you and me, which is $250,000 per annum. LRS, which is liberalized remittance scheme by the RBI. You and I, we have a 250,000 limit. If you are using more than 10 lakhs as per the latest budget, you have to pay 20% tax, which you can adjust it as an advance tax. The TCS, as it is called, tax collected at source. If you are remitting from LRS, you have to pay above 10 lakhs, you have to pay 20% TCS. The TCS is something we can adjust it like an advance tax. It's like a TDS payment against your regular payments. In the case of NRE account, there is no limit for withdrawal. In the case of NRO account, you have a limit of 1 million. NRO account, interest earned is taxable. NRE account, interest earned is non-taxable.
NRE account, interest account taxable.
It is non-taxable in India. In the US, you have to pay tax. Okay, these are the fundamental differences between NRE and NRO.
So ideally, you should have both the account.
You can have both accounts, provided you are funding it from there and then doing it. One of the advantages that you will have is you get the benefit of the depreciation of the rupee to that extent.
Achha, even if you are having one account only, and that can be termed as the NRE and NRO account.
No, they are both distinct.
Achha, so if the outside income you are going to credit it into the NRO account, then they won't accept it.
They will accept it, but you can't take it back. So why should you do it? Unless you want to settle down in India, that's a different matter.
Achha, for your own purpose, for this.
If you want to take out that money without limit, then
But
you
in
do it in
India,
an NRE account.
for Indian purpose, Indian expense purpose, he can use
You can use that NRE account also for purposes for India.
or NRO account also.
NRO
But
account.
NRO account you cannot use for remittance outside.
You can use it for remitting outside India up to
Subject
1
to
million. Up to 1 million.
Every year.
Yeah.
1 million Indian rupees.
Yes. No, dollars. You $1 million.
$1 million.
Yes.
And there will be no taxes.
No, you have to pay taxes because if it is an NRO account, whatever income that you have, you pay taxes and then only you go to that account. So you have to pay taxes in India on the earning. That's a different. NRO account withdrawal is a cash flow. Income taxation is different. What you are talking about, withdrawal is a cash flow issue. You can withdraw up to $1 million. Of course, you should have paid the taxes. That's independent. Sorry, you had some question? Yeah. Or we might put it.
So one question.
No, they can do it, please.
Sure.
Hello. What is the consequence of not converting the resident account to
Savings account.
not converting resident account? Hello.
So RBI can freeze it, they can impose penalties on it.
I see.
That is the only. But you have more than 60% of the people who have it, the banks don't bother. I am not recommending you do it. If you are aware, it's better that you do it. See, the reason why, in any case, one more issue that I want to highlight is, you can have an NRE and one NRE account and one NRO account only.
Achha, only one.
Only one. Because particularly in the case of NRO account, if you have multiple accounts, the government will not be able to track the outflow. That is the reason why it is not possible for you to have more than one NRO account.
In different banks you can have?
You can't have only one bank you can have. That's what I'm saying. You can have only one NRO account in one bank because you have a limit for withdrawal. And that limit is tracked by the bank as well as by the RBI. That is the reason why I'm highlighting this. Yeah, the lady there.
This NRE account can be maintained in the dollar.
NRA account? No, you can't maintain. It has to be converted to rupees. It automatically gets converted to rupees.
So you cannot have into dollar.
No, you can't. But you can repatriate in dollars obviously to the
But
rest.
exchange rate will be applied.
Yes, so you benefit because it's the rupee is depreciating.
But in NRE account, if the person is having the remittance from outside India, can he request the bank to have the dollar?
I don't know about that. I don't think so, but I don't know about it. Yeah, yes, please.
So regarding PFIC, you said there's an exemption for certain pooled funds. Like, is PMS covered there or all pooled funds?
No. PMS is not a pooled fund because the securities are held in your name.
Okay, so it's
And you pay taxes on a quarterly basis.
Okay, so it's kind of a workaround instead of investing in mutual fund, they can still go for the PMS route.
The answer is yes. Though I don't know whether PMS is a better alternative.
Because of the cost.
I don't know. I have very strong views. I don't want to talk about it. I wouldn't recommend any of the people who come to me to invest in a PMS because the returns that you get. So the difference between a PMS and an equity mutual fund is whether you want to have a diversified portfolio or whether you want to have a concentrated portfolio. Most of the investments that I have done in PMSs, I have realized that it is a mistake to have invested in a PMS because the mutual funds would have given me better returns. So to that extent, yes, in the case of the US person, the consequences are higher, but I don't know if you compare it in terms of returns, whether it is there. So that's an informed view. While it's a workaround to avoid taxation, I don't know whether it is a better alternative to that extent.
Sir,
basic question, sir.
Sir,
Let him ask. Yes.
sir, one question here.
Any inputs on 15 CA, 15 CV issues?
Yes, that will be there in the case of when you are.
Suggest inputs.
Huh? Yeah, so you will have those issues if it is relating to income. So if you have transfers happening from an NRO account, particularly you need to address that if it is in the nature of income. So you will have 15 CACB issues relating to payouts from India. Even if it is not applicable, for safety purposes, the tax will insist. So that is another issue.
Hello, sir. Yeah, Indian company deducting TDS on an Indian component of salary for a second-hand employee. Is it correct?
Yes, it is, because the income is earned in India.
But the payment and everything is rendering of services is outside India. How
That
does
doesn't
this-
matter, they have to fund it. They have to fund it. See, today, where is the source of money for them to pay in India? So today, what you are telling me is, the person is working in India, all his payments are happening outside India. At the end of the day, the company has to pay the TDS amount. You can't say, I don't have money to pay. It has to be done. No doubt about it.
So there is a news recently that many NRS are selling their ancestral properties in India. What is the reason?
I don't know the reason, but if they sell, they have to pay tax.
Especially in Andhra, they are selling in a huge number.
You are asking the wrong person. I don't know.
Taxation point of view.
There is nothing. You have to pay taxes there. Please remember one more thing. If a non-resident is selling a property in India, what is the TDS rate? I am asking you. Sorry? Wait, 20% is the withholding tax. If a non-resident sells, if a resident sells, please remember, so you have a high tax on the sale of a property by a non-resident to that extent. Okay, that's only for information. Yeah, you have somebody had a question.
Just to understand one easy question.
Huh?
For filing the return, they follow the calendar year.
Correct.
And we follow that.
So you will have that mismatch.
So the 3-month difference, how to this one?
So you can split it in terms of the number of months and do it. Otherwise, if it happens in the calendar year itself, during the second half, depending on whether you have done it in the April to March or after April, January to March or after April, you can choose to wait. It's a tricky question. There is no answers to it. But the US will accept whatever you do as long as you do it consistently.
Yeah, so that for that in Indian return, I can consider Jan to December every year consistently.
No, in the case of India, they have very clearly said that the tax deduction has to happen in the year in which the income is being subject. So if you are going to offer that, so today essentially you will do on an accrual basis. So in India you don't have that option. Whatever is accrued in one particular year, the fiscal year you have to pay in that. So January to March, if you want, it will go in that particular year. So you will have a timing issue to that extent. But yes, it's a tricky question. There are no easy answers. But in the United States, there is an option for individuals to synchronize your tax filing from a calendar to a fiscal year. So you have that option there in the United States.
And sometimes the client that asks to transfer the fund from NRO to NRE, for that they have the 15 CSCP because
Yes,
they were having the income in India.
Correct. So you will have an issue there when you transfer money, particularly from NRO to NRE account.
So cut off a HUF becomes citizen of US. How the taxation?
It will be similar to what the individual is.
Because here in India it is a different distinction.
Yes, in the case of US, they don't know what a HUF, so they will treat you as an individual and do it. So there are challenges. There are challenges for partnership. In India, a partnership is a taxable entity. In the United States, it's a pass-through entity. So there are differences, there are challenges, particularly for this kind of entities.
If a person who was a resident had an HUF, then went to the US, became a US citizen, then came back to India, that income earned in that HUF, that's that, I mean, this is US.
I don't know the answer related to, because the concept of HUF doesn't exist there, and I don't know whether the HUF can exist when you have gone. I don't know about HUF taxation, so I don't have an answer to that.
You mentioned about the NRO, can only have one NRO account, but if a person has multiple accounts here,
Again, they can issue.
So he has to close down.
Non-compliance, RBI can come and fine you for that.
What is the person supposed to close down all the others?
He's supposed to close all the accounts except for one account and also SB accounts if they have.
The responsibilities of the person who is having those accounts.
Correct.
So what about the difference in tax rates? We take the credits, and if there is a difference in the tax rates between the US and the Indian income, what about that?
Okay, I have missed that, but to give you a short answer, India follows a credit mechanism. Okay, generally you have an exemption method and a credit method. India follows a general credit method, ordinary credit method as it is called. Under the ordinary credit method, you pay taxes, you calculate taxes on each source of income from each country or whatever it is, and then you are supposed to pay tax. So you pay taxes in India as per the India tax rate. Okay. Let us assume, for instance, that you are an Indian citizen having foreign source income. You pay taxes at a particular rate. You compute the tax rate in India, and then for credit purposes, you take the tax applicable in India as per the India rate, and then you see what is the tax paid there, and you get the credit only to the extent of India tax credit. The reverse also happens in the United States. With the tax paid in India, okay, they will also calculate on a similar basis in the United States. They will calculate the tax applicable as per their country rates, depending on your tax slabs, and whatever tax is there, they take a credit whichever is lower. So both the countries follow ordinary credit method. Under the ordinary credit method, the impact for an individual is higher of both the countries' taxes, because you pay tax at a particular rate in the source country. You pay the differential rate of tax if the resident country has a higher rate of tax. Now, if the resident country has a lower rate of tax, you will get credit only to the extent of tax payable in India. So, to that extent, the taxes that you have paid in the overseas country, less the tax payable in India, you will invariably have higher of both the taxes.
Thank you, sir.
Other method you said, other than ordinary?
There is only one ordinary credit method, other than you have exemption method. India doesn't follow the exemption method. Majority of the countries don't follow the exemption method. There is also, other than ordinary credit method, you get a full credit method. India doesn't follow full credit method, US doesn't follow full credit method. Under the full credit method, whatever taxes that you pay, you can take a credit to that extent. And whereas under the ordinary credit method, it is tax payable in this country or in that country, whichever is lower, you get a credit.
Sir, any basic exemptions in US laws?
Yes, you have, just like you have 4 lakhs in India now, you have exemptions also there. That will impact your effective tax rate in the United States. And you have a different rate of tax, just like in India you have a different rate of tax, a lower rate of tax for capital gains. In the United States also you have a lower rate of tax for capital gains, except in India you have one single rate. In the United States you have 3 slabs for capital gains also. Last question, if I may say so.
Okay, thank you. So these are the 2 practical questions which has been asked from my client. So one related.
Separately because I need to charge.
No, I am solving all the things today. So okay. Yeah. So while I'm aware of the NRI account, but then the question was that if an NRI wants to transfer money for the education for their child from the NRE account, whether the LRS will be applicable. When I heard you now, LRS
doesn't apply for non-residents, only for residents.
Yeah. So the reason why I asked you, because the bank knows it's an NRI, but still they were pushing them for the LRS.
No, they can't do it. Because LRS applies only for savings bank. LRS doesn't apply for NRE and NRO account. The bank is wrong.
Very good, clear. The number 2 point was, there's quite a few chartered accountants now suggesting their clients who are a US citizen, because quite a few of the US citizens think that rather than bringing the dollar in India, they want to transfer the money through the Dubai to Singapore and then transfer the money for the education of the children in dollars. They don't want to bring, okay. So the way there is a structuring which is suggested by the chartered accountant is that if I am getting any money in
Your person is a non-resident?
is a citizen of USA but resident in India.
Okay.
Resident in India wants to set up an account through the Dubai for free trade zone, something.
See, today, if you are a citizen of the United States, whatever money that you have won, before you become a tax resident, you have the flexibility in order to get covered by the Indian tax regulations.
Okay.
If you are talking about income earned in India, then you will have these issues. In which case, the primary bank account will be an Indian bank account. Today, let us assume your US citizen has earned tons of money.
Yeah.
He doesn't have to bring that to India just because he lives in India. He can do whatever he wants with that money before he became a tax resident. After he becomes a tax resident, anyway if he is earning any money outside India, that also he does not have to bring to India. He only is required to pay taxes in India. So there are two different issues. One is taxation, one is cash flow.
Yeah. So in this particular
So
case,
to that extent, whatever the chartered account is talking about, this convoluted route, I don't know is required. Because please remember, I am only telling you a very simple thing. The law requires you to pay taxes in India on your global income. As long as you pay the taxes in India, that's okay. If this income is earned outside India, they don't necessarily have to come to India. The law does not require you to do. You have the flexibility. Today, for instance, you and I can invest up to $250,000 outside India.
yeah.
I sell a particular stock, I can reinvest, I don't have to bring that money.
Yeah.
So there is no need for a non-resident to bring that money into India for him to do all this drama.
Yeah, so in this particular case, it's a tax resident in India
That's
who is
right.
on the income after being a tax resident
Okay.
from USA,
That's right.
which he thinks that rather than bringing to India, he can route it through some other parts and back to the USA for the spend.
If he's earned in India, he doesn't even have to bring it to any other country to bring it back to US. He can earn money in the US. He has to pay taxes in India.
Yeah.
If it is a US source income, he has to pay taxes there, he will take a credit here.
Yeah.
Okay, that's a different scheme.
Yeah.
But essentially, cash flows, if it is earned outside India, they don't have to bring it to India.
And this was basically for the tax part. So the cash flow is clear, but then the
But they
CA
have
was
to
advising that you don't need to pay
if
tax.
they don't have money in India to pay the tax, to that extent they have to bring the tax to India. Very clearly, there is no problem. They can pay taxes from the US also to that extent directly. The regulations don't prohibit you to pay taxes only from India. You can transfer money from your bank account also. If the linkage is there, I don't know about that, how well it works. But if you have to pay taxes, if you have to bring that India, you bring money to the extent of paying taxes.
On that point, I have a question. If it is an Indian,
Last question.
if it is an Indian employee who has got stock option from a US company and he sold it there, I think there is a rule that he has to bring that money to India. So there is an exception to what it is.
That's correct. Right. Thank you all for this session. I'm very happy that so many people I'm more expected more people to be around.
All are awake. All are awake. Rather, you get them awake.
So who else can take this subject, talk about this subject better than Krishnan sir? So wholehearted thanks to him for coming here and sharing his knowledge with us. Thank you so much, sir. I request our chairman Pramod to hand over a memento to sir. So thank you on behalf of the board. Thank you, sir.